Todd, these structured protection products, they're part of a larger group. You and I have talked about this. Target outcome products, I don't know what we should call them, but it's a whole group of them. They basically provide some downside protection while still staying in the market. So we've covered the JP Morgan premium income product. That's JEPI, J-E-P-I. That, in there you're selling options to generate income.
Right.
We've also talked about buffered products. Bruce Bond runs buffered products that deliver partial protection against the downside. Here we have full protection. What's the appeal of these products? They all kind of offer protection. Why are they being sold?
When you think about ETFs in general, they're an innovation vehicle. Right? We started with plain old passive vanilla 30 years ago, moved into bonds, moved into active fixed income, active equity, and now we have this option derivative explosion. This is the next step of the evolution of the ETF. And I think when you think about broader American demographics, there's a lot of adults approaching retirement who will have money on their balance sheet who still want to stay invested, but they don't want to have a recurring 2000 or 2008 type scenario. So these products make perfect sense for those who want to still generate equity return, but have that protection. Yeah. I think that's really important here.
I think that intellectually it makes a lot of sense. We constantly warn people about the dangers of market timing, that you can't, if you're really nervous, but you still want to stay in the market, you can't pull out and then put money back. It's very dangerous to do that. We know that market timing generally doesn't work. So how do you still stay in, but you're nervous? It seems like this answers at least some psychological need at the very minimum.
Yeah, definitely psychological, and the asset class, right? I know Matt and his team, they're going to have large cap, small cap. I assume international, I think, is probably involved in there too.
So you have S&P 500, NASDAQ will come in June, and then we're on file for Russell in July. I think if you look at the buffer ETF space, in a low rate environment, you can do really good upside capture with a buffer. But as rates have moved off of 0 or 4 or 5% now, we can afford to deliver capital protection over an outcome period. And when you can do that, there's a lot of opportunities to use these products, not just for de-risking equity markets, but there's cash on the sidelines. People are now buying CDs, they're buying money markets again, they're buying fixed index annuities. And so now you can get capital protection over an outcome period. It's a space the ETF really has not captured yet.
Yeah, go ahead.
You think about this in terms of asset class too. If long duration bonds don't work, this is also a substitute. Because if you can generate that low single digit return with the protection, that's another way to get your income, assuming equities are still okay.
That's
so
right.
Do you have any data on, you must believe obviously there's a target audience here. Older people makes a lot of sense as a target audience. Anybody else out there?
Yeah, I think retirees looking to provide for themselves when they no longer work, this gives them the opportunity to outpace inflation. You can get greater than the risk-free rate, upside of the market. Your money is linked to the market.
Right.
With
And
no
this is
greater
tax
downside
deferred
risk.
too? How is
this? This is all tax-deferred growth. So let's think about your trade-off. You could go into a 5% guaranteed product. The end of that term, it expires, and you're going to have to pay ordinary income rates on that money. So your 5% will turn into, call it 3.2%. Or here's your trade-off. You can turn that in, get the upside of the S&P 500 to a cap of 9.65%, and you can earn much greater than what the risk-free rate is delivering.
So what happens after 1 year after this? You suppose May 1st somebody buys this product. What happens May 1st next year?
Yeah, April 30th of next year, the options will expire, and they will enter into a new set of options. You'll get a fresh 100% protection level and a new upside cap.
So you can just stay in, it rolls over.
You stay in. That money will grow tax deferred and can compound tax deferred. And then if you've held the product for longer than 1 year, you're not paying ordinary income tax at the end.
And even if I'm not in a tax advantage account, even if I'm not in a retirement account, even if I'm just in a regular,
like a regular brokerage account, yeah, this money grows tax deferred. You hold the ETF longer than a year, you pay long-term capital gains when you sell.
Okay. Well, that's an additional benefit right there, just the tax deferred.
The tax alpha is huge.
More magic in the ETF wrapper. That's basically
it's really quite remarkable.
Yeah, and I think that's one reason people have always said, like, could I do this myself? It's like you could get close, but you can't get quite as efficient as if you were to do it inside the ETF wrapper.
And this is, I keep looking for innovation here. You and I keep talking about the maturation of the ETF business. And most of the money that's coming in, $500 billion or so that comes in every year, still goes into index funds, plain vanilla index funds. And the industry is looking for ways to get new products in. Most of this this need for innovation is because of the saturation in the index business. So the business needs to grow.
Yeah, this is one way, through options, through more complex, sophisticated type strategies that the common investor may not be familiar with, but there's clearly a very good value proposition. And unless you get a significant bear market, that money's going to stay in those index funds, right? There's no reason to sell out of them unless you have to for some taxable reason. So issuers will continue to innovate. There's going to be different types of these strategies. I'm sure Calamos will come up with another way to spin it, whether it's different protection, different asset class. I mean, who knows? We'll have these in crypto for all I know in a couple of years. But it's just more from the ETF industry. I think you cannot fade this industry right now relative to other vehicles that are out there.
And yet people still seem to be in love with their money market funds.
Yeah.
And who could blame them at 4.5%? Whatever we're getting right now, why move at all? It seems like a lot of fairly risk-free, at least short term.
Yeah, we're seeing upwards of $9 trillion across CDs and money markets. I mean, that's larger than almost the ETF space itself. And so these types of investors can now enter into an S&P 500 upside with no greater downside risk over that outcome period. So I think there's a lot of money on the sidelines that could move into this.
And you're launching additional suite of products around the NASDAQ 100 and the Russell 2000 as well.
Our plan is to launch 12. We're going to launch one every month for the next year. We want people to have a chance to get in at that beginning.
But it's 3 different groups, like the S&P 500, NASDAQ 100, and the Russell 2000.
And then we're going to repeat that series. So S&P in May, NASDAQ in June, Russell in July, S&P in August, NASDAQ in September. Keep repeating over the next 12 months. There'll always be a monthly entry point.
So you'll have 4 of them essentially, 4 S&P 500.
That's correct.
And 4 NASDAQ 100, just different strike expiration or different
expirations. That's right. That's correct.
And where else do you see this going? I mean, what other kind of products do you see? I'm just asking you to put on your ETF thinking cap.
It's a fantastic question. The ETF vehicle is 30 years old. The mutual fund turned 100 this year. So there is a remarkable amount of innovation that I think is going to take place over the ETF, over the next several years in the ETF wrapper. We really like to look at where flows are going. People are now, like you said, buying money markets again. They're buying CDs again. We can deliver capital protection inside of an ETF wrapper. That's extremely innovative. It really couldn't have existed over the last 10, 15 years in a lower rate environment. Now the rate regime has shifted, and we've got this whole new wave of innovation that's going to come through the ETF wrapper.
Yeah.
I'd be curious, whenever rate cuts decide to come along, and you get them down to 2-3%, the proposition of money market funds really declines. So I wonder if a lot of that money will find its way into these types of strategies.
But you're making an assumption there about going down to 2 or 3%. Where is that? Where do you think that's coming from?
Not this year.
No, I don't.
Not this year.
Yeah, it seems,
later
higher for longer definitely seems to be the mantra.
Yeah, that is here.
So too.
Wouldn't you be surprised if money market funds went down to 3% this year?
It's not happening this year. I don't
I
want to make a proclamation.
Maybe going down to 4%. What are you getting now? 4.5, somewhere around there.
You can get 5.25 on a Vanguard on a Vanguard money market fund.
It's 5.25 right now.
It's something roughly.
That's an amazing proposition. And still money inflows though into bonds this year. Still.
Yeah, I mean, active fixed income I think is a really big opportunity for issuers outside of the whole option product explosion that's going on. They are about 12% of industry AUM, that's including mutual funds, and really growing fast. I think a lot of investors have realized they need a professional hand at the wheel when you change interest rate regimes like we did recently from 0% all the way to 5%.
But this is the argument the active guys always make. Oh, in a volatile environment, we're going to outperform the passive guys. This is the one turn in history in 40 years in the bond market where maybe if they did it, they would have added some value. Other than that, in the last 40 years, it hasn't mattered.
No. Well, that's the marketing for it, at least right now. We don't know if we'll revert back to the lower path of interest rates, but I think issuers are looking at it as a higher for longer, as you were saying before, so you want that active touch.
I think the growth in options ETFs too is largely driven by that low rate environment. We saw it being difficult to get risk management and income from bonds when rates were so low. Now that we're moving out of this, you can actually use bonds once again for risk management and income. And so that's what we're seeing at Calamos as well.
All I know is the viewers message me all the time how deliriously happy they are at 4.5 or 5%, and that money is very sticky in those money market funds, and that is very real competition for the stock market right now. When you get a risk-free at, 5%, and it's a real rate of return now, you're getting a positive real rate of return. That's real competition, and I think it's terrific. I don't think it's terrible. I'm perfectly happy to see the competition for the stock market because this makes sense. 1% 10-year yields did not make sense, which we had.
No. Yeah.
Who's going to give the government 1% for 10 years? It makes no historic sense at all.
Right. It's a nice extra stimulus, especially you're dealing with inflation here. But having the 5%, whether it's real or nominal, helps you pay some sort of a bill.
And I keep complaining. I mean, viewers are messaging me. I don't want a 6% mortgage or a 7% mortgage. I said, I got news for you. 3% mortgages are not normal. That was never normal, and I don't know why people thought that was somehow the new normal, and it never was. That was an anomaly that happened there. Yeah. And I'm glad people took advantage of it, but if you think that it's going to go back to 3%, I would not bet on that. 6 or 7% is much more normal interest rate for a 30-year mortgage. When I got mine in 1985, it was 11.25%. And that was typical throughout the 80s and into the early 90s.
I will say the part of this, the benefit here is now you're seeing more targeted duration fixed income ETFs, right? Yeah. You have whole suites now saying you want 1 month, you want 3 months, 1 year, you can get it. You don't have to buy a market money market fund. You can do it in an ETF too.
Yeah. Well, gentlemen, thank you for coming by. I appreciate it. Again, the key point here is these kinds of products are filling a niche for people who are concerned about the markets, maybe a little older, but still want to stay in the market